Financial expert Mark Lamkin is trying to save us from ourselves today. He's telling us the 5 reasons, the most common reasons, that retirement savers fail at their efforts. We all hope to be good at this, and I think a lot of people think if I'm saving money, I'm being successful, but that's not necessarily the case.
I'm happy you've taken the first step, but over the last 23 years, Candace, I've seen people make the 5 same mistakes, and we're going to fix them this morning.
Okay, starting off with emotion versus behavior.
The biggest mistakes I've made in my life has been when I've made emotional decisions, and investing's no different. People get really emotional about their money. In the last 20 years, the markets have averaged about 8%. Investors have only averaged about 4%.
Oh, wow.
And because historically they do the wrong thing. When the markets are high, they're buying. When the markets are low, they're selling. So I want you to have a plan. Don't get emotional. Do the same thing time and time again, regardless of where the market is.
All right, second on the list, bond bear.
This one shocked me when I did my research for the segment. Stock people made about 50%. Bond people, the market did about 6%. Bond investors only did about 1%. So only about 15% of the return of the market. And because the media scared them into saying extremely short term. If you're going to have a bond allocation, again, have an overall plan, have an overall allocation, and stick with it. And don't get crazy on going short term, long term, mid term. Have a little bit of each of those and stay consistent.
I think a lot of people think, well, bonds are safe. I don't need to be in the stock market, especially as people get past 40, 50, getting closer to retirement. You hear that advice of, oh, get it out of stock because you can lose everything.
That's right. In the right types of bonds. When I say the right types of bond, have a little bit of short term, mid term, long term, and you'll be fine long term.
All right. Finally, experts, relying on experts who are not always experts. They're more analysts, I guess.
Yeah, when you turn on CNBC, you're going to see someone touting the stock of the day. But realize for every single stock, for every buyer, there's a seller. And for every person that says the market's going higher, there's one that says it's going lower. So if you're trying to manage your retirement by every move an expert makes on whether it's the newspaper or Kiplinger's or Money Magazine, you're going to get frustrated and you're just going to get quit because you won't know where to go.
And it goes back to being emotional.
Analysis you'll be paralyzed by analysis there.
Okay. Next question is how much? That's a question that haunts a lot of people, I think.
This is the biggest issue I see people face. They've never taken the time to see how much money they need to save. Let me give you a quick example. If you realize that you're going to need to save $50,000 in retirement, then that means take $50,000 divided by 5% standard withdrawal rate. That means you're going to have about $1 million. If you're 35 years old and you're going to quit or retire at 65, that gives you 30 years to save $1 million. There's a great financial calculators on the web that will say how much do you need to save and what you need to earn. Okay. That'll give you a quick starting point on where you need to be.
And then we tend to get greedy with our money, and you say that's a big pitfall.
Last one, pigs get flat, hogs get slaughtered. And if we do that previous exercise and you need 8%, quit investing like you need 10 or 12 or 15%. That penny stock doesn't cure cancer. It's 6 cents for a reason. Don't invest in it.
Okay, very good advice.
Thank
you, Mark. And if you want help in planning your retirement savings, Mark can help you. He has a couple locations in Louisville. There are the addresses and his phone numbers on the screen, 961-6550. We have all this information on our website as well for Lamkin Wealth Management.